Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Paul Garofoli with The Standard. Welcome. Welcome to the studio today.
Great to be here as always, Scott. Always an honor to be on your podcast.
It is great to be here. It's great to be alive. It's great to be in this business. It's a historic time that we find ourselves in, being in the annuity world.
Absolutely. Record-setting years at The Standard, 2 years in a row. Let's make hay while the sun is shining. But it underscores how valuable our products are in these volatility times.
When was the last time that you can recall having this sizzle to go along with the steak like we have right now? Or is it the other way? Is it finally the steak to go with the sizzle?
We got both. It smells good and tastes good.
I mean,
it's really
it
good.
has to have been 12 plus years ago, right?
Well, indeed. I mean, we've all been struggling in the low interest rate environment, and everything is, comparable.
Right.
If all the interest rates are low, then if our interest rates are a little bit better, we're good. But this significant rise in interest rates and in terms on the fixed index annuities, really 10 plus years ago, maybe it was pretty attractive. I think probably the most recent would be the financial meltdown of 2008 and 2009. We saw that parade to safety, which means annuities. So that's the last time it's really been this lucrative, this positive. And I think one of the changes that I've seen, Scott, is that the other financial elements in our industry, or sometimes that we compete against, the financial press, the general press, a lot of people are more open to the annuity concept and not just deriding it just for its own sake. That
Right.
There's a lot of positivity. Now, a lot of that has to do with product innovation, which we're going to talk about today, shorter durations, better terms, more consumer-centric value, which the Standard takes pride on delivering. So all those elements have come into play where, annuities are not a dirty word anymore. They're really been positioned, thanks to the efforts of people like you, carriers like the Standard, the firms you represent, that there are a great alternative asset. And it really should be considered an asset class in and of itself.
Right. Amen to that. Finally, we've come to this place where annuity is no longer this dirty word. Certainly, interest rates have considerably helped and drive. Also, like you said, the adoption rate amongst, I would say, the industry or the world as a whole, the financial and insurance landscape, banks, credit unions, large institutions, just fully adopting these. Also, which we'll get to, investment firms, so investment banking firms, Merrill Lynch's, Goldman Sachs of the world are also helping to create indices and strategies that are on the underlying chassis of these products. So I want to get to that. But before we do that, let's do the formal. Your title, and also more so, aside from the title, what it is that you find you doing in your current role, and then if you could talk a little bit about the Standard.
Oh, happy to do that. So Paul Garofoli, Regional Vice President with the Standard, celebrating my 41st year in the business, mostly as a...
Have you figured it all out yet?
I'm getting close to it.
Right.
I'm getting close to it. But the key, Scott, is once I figure it all out, then that might be the end. So I believe in continuous learning. I'm learning more things. What you may or may not know, I was just elected to the board of directors for the National Association for Fixed Annuities.
Good for you.
So I don't know if that's like kind of a lifetime achievement award because I've been at it so long, or maybe I can add some value. But no, I'm learning a lot in all elements of our business. There's so many things to know about the construction of indexes, construction of products, the environment, the economic environment we find ourselves in, the nature of competition, where all these things fit in. So I am constantly learning all the time. And what I am is basically an evangelist on behalf of the Standard and its products. So I kind of serve two roles. One is obviously to promote the use of our annuity products. I'm all annuity all the time. And then the other part of what I do is educate advisors, agents, people that may even be new to the space to get them comfortable with basic concepts. So, I consider myself both an educator and motivator. And relative to the standard, great company to be affiliated with, steady, consumer-centric, diversified, great ratings. We've held an A rating ever since AM Best has rated insurance companies, one of 5 insurance companies that have that distinction, and the other 4 are big name brand companies that...
And the parent company?
The parent company is Meiji Yasuda, Japan's largest life insurance, and I'm glad you raised that because those elements go together in that the Japanese, when they look at business prospects, they look at long-term. Some companies are owned by private equity and they're subject to quarterly earning pressures and short-term. The Japanese, and Meiji Yasuda, looks at business not in months, not in years, in decades. In fact, the motto is peace of mind forever together. And really, that's what we deliver in our industry in general and at the standard specifically.
And they have an exceptional credit rating, correct?
Oh, no doubt. I mean, the highest of the highest in that regard, well regarded in Japan, and then branching out internationally, not only with the standard, there's another annuity company that they own, Pacific Guardian Life, that's very well regarded in certain niches. So great company to be affiliated with.
So today's topic of conversation is all around the A word, annuity.
Yes.
However, that is not the only product line that the standard does represent. Can you talk a little bit about the different product line? Not to get into details, but to just give some perspective of the fact that this is not just a one-trick pony. This is an organization that specializes in group insurances and business insurances and other lines.
Right. So, I think in general, when an advisor recommends or a consumer chooses an insurance carrier, you want that carrier to be diversified, and the standard is diversified. Now, I represent the annuity division. I'm all annuity all the time, but basically, the standard is comprised of 4 distinct businesses. You mentioned one, the group insurance business, group life, group disability, cancer policies, things like that, everything but medical insurance. So that's one element. A lot of advisors, Scott, I find, know the standard as a disability company. We've been in the disability business since the dawn of the company. Very unique. A lot of carriers have left it. A lot of carriers have consolidated, but we've held true in that regard. And then the other element of what we do is traditional retirement plans, meaning 401k plans and administration. And then that 4th leg, again, the leg that I represent, is the annuity division. So those 4 different businesses, one of the things that I try to train people on is you want your carrier to be diversified because those businesses react to different economic circumstances. So when you have that level of diversification in the carrier, the businesses are complementary. So it works out real well as a fountain of stability for anybody that's a policyholder with the standard. So we have that, and then the Japanese ownership even add that additional layer, hundreds of billions of dollars of assets. It's really quite substantial and really a joy to represent.
Okay, thank you for that. That's provides some great insight. Now let's double click on some specific annuity applications today. Today's all about helping the advisor optimize their practice, what I call shop talk. Some unique features and some unique elements that I think are critically important that the audience understands and advisors know at large about the generally the standard annuities. One, I get this question all the time. And it's a funny one because to me, being in the industry, annuities aren't for older age clients. This is a common misconception by even advisors who are seasoned in the business because they're punitive. They're not full account value. There's all these prohibitive thoughts, misconceptions, and misunderstandings. First of all of the annuities that the standard represents, and therefore most of the annuities, if not all, that we represent as a company are full account value upon death. There are liquidity waivers, nursing home. We're not getting into the weeds and all of that today. But what are the maximum issue ages that the standard does provide? This is a very unique and value-added proposition that is offered by the standard.
Yeah, I love the whole concept. We're going to discriminate against older people because we don't want their money to be safe. It's actually, contradictory.
Completely counterintuitive.
Right.
I mean, it's like, yes, they've accumulated all of this wealth over 60, 70, 80, 90 years, and now we want to preserve it without fees, eliminate downside risk. Why wouldn't an annuity be a place for that money at the end of time?
Absolutely. So to your question, we go up to age 93 for 5-year, 3 and 5 year duration. So you can, and that's both on a multi-year guaranteed annuity, traditional fixed annuity, or also a fixed index annuity, FIA. And then we'll go up to 7 years, up to age 90. So 7-year duration on those products up to age 90. So we're certainly focused or able to serve the super senior audience. The durations are relatively short. I think they're reasonable. And then, as you mentioned, there's still lots of liquidity provisions and ways to access money. So it's not punishment, it's a reward for all that hard work and savings, and allows them to earn competitive rates or potential upside by way of indexing.
Okay, the other unique feature that the standard has specialties in and product offerings in, which is becoming fewer and further between, is in the area of Medicaid solutions, Medicaid planning. What does the standard offer that many don't any longer?
Yeah. So first and foremost, Scott, we are in the Medicaid so-called friendly immediate annuity business. We call it a restricted SPIA, single premium immediate annuity, where the payment is non-transferable, non-cancelable, non-redeemable. That may help some people qualify for Medicaid help by way of converting an asset that's countable against qualifying for Medicaid to a stream of income that can either support the spouse or even support the person going into the nursing home up to a certain limit and still preserve their eligibility. So that's step one, or that's element one of that. The second element, which I do a lot of training on because I think it's overlooked, is that our regular stuff, the regular MIGA, multi-year guaranteed annuity, the regular FIA, including the product we're going to talk about today in a little bit, it is convertible at any time without penalty into a stream of payments, either just regular payments at any point in time from day 1 to day 100 to day 10,000, or to a restricted payout that might help with the proper planning and proper guidance and the advice of an elder care attorney that might help somebody qualify for Medicaid. The big drama a lot of times for people that own any assets, including annuities, is if they're in that situation where those strategies may make sense, they actually have to cash out their annuities typically, suffer surrender penalties typically, and then what happens is their elder care advisor will go buy a restricted immediate annuity. So we have that privilege already built into our products for that percentage of our policyholders that may need that type of planning. So no drama with that. Very client-friendly to have those provisions, whether it's just regular income or restricted payout income that might help them qualify for benefits.
Excellent, thank you. And to reiterate, you nor I are licensed legal attorneys, nor do we give tax advice. That is very important. And you stated the fact that this is a very particular space where the advisor and their client should consult with the proper elder law attorney before proceeding down this path. It's a very niche space. It's state-by-state variances. However, the key point is that Standard is a very Medicaid-friendly company, probably one of, if not the only one, that is as friendly as you are.
I think that's a very fair statement to say.
Okay, moving on from there. The newest product suite on the market, from a Standard perspective, it's a top seller for us for many, many consumer-oriented reasons. We are a firm that specializes in short duration solutions that are competitive and really, really the best solutions from an accumulation place standpoint for the advisor and in turn their customers. I'm going to go out on a limb here and say, with the exception of very specific reasoning, especially in today's day and age, shame on those that sell longer duration products, because there is no direct consumer value to the consumer. You should be utilizing 5 to 7 year, or if not shorter, if it makes sense. Again, the disclaimer, unless there are particular reasons like guaranteed income, like a death benefit play, like long-term care planning, these would be very good reasons to consider a longer duration solution outside of a 5 to 7 year index annuity. Moving on from that, we enter in the Enhanced Choice Index Plus. Talk a little bit about this and why you're seeing such an interest and an incredible amount of volume from a Standards perspective I would say like the likes you probably have not seen as a company.
Yeah, we set records both overall production in annuities in general, but specifically with our fixed index annuity business. If you went back 3 or 4 years and asked a typical producer or even a distributor like yourself and said, what's the standard good at? Oh, they're really good at MIGA, multi-year guaranteed annuity rates, and some of the other consumer features we've talked about. But that would be the association. What about FIAs? Well, they got a kind of a nice one, but not really.
And and good for older ages. The things we talk about, Medicaid friendly. It's like vanilla ice cream.
Yeah. And so,
nothing wrong with it.
No, there's nothing wrong with it. But
where are the sprinkles?
Well, we got sprinkles and some ice cream and a cherry on top.
That's right. Let's talk about that.
With the Enhanced Choice Index Plus. And this is, in essence, our Enhanced Choice Index 2.0. We introduced the product last April. Got a nice reception on that, but we knew that there were some additional things that we wanted to add. Just like with any innovation, you want to upgrade, you want to improve over time. So this year's version, Enhanced Choice Index 2.0, is Enhanced Choice Index Plus. And what's the plus? Well, what we've done is we've added a super competitive proprietary index unique to the standard. We've added the ability to index every day that we issue a policy. And that's kind of inside baseball sometimes with the advisor community, but we were indexing less frequently, so people will capture whatever that index value on the underlying index allocations they choose every day that we issue a policy. And then the third, which I think is the big distinction, is we've added probably the best death benefit rider in the business on a fixed index annuity, bar none. I'll debate anybody. Bring them here. We'll have a debate. I'll win because the benefit is so beneficial, so strong, adding a significant value to the consumer for those people that are focused or want that option on their fixed index annuity.
Okay, so you just came from, and I want to do two things. One, let's talk about the conference you just came from, which was the
National Association for Fixed Annuities Distribution Summit.
There you go. And there's always been a lot of talk, and they have great resources, by the way, around these volatility-controlled indices. I mean, there's how many exist? There's well over 100.
There's like 656, I think,
okay,
unique indexes. Well, there's variations. I mean, you might say there's, on the underlying indexes themselves, 100 plus, but then the different measurements, high water mark, low water mark, annual cap, triennial, biennial. So all the different variations, you're up to about 656 different ways to measure those underlying indexes.
Okay. That makes sense to me, depending on how I slice the crediting strategies,
right,
the calculations, returns, things of that nature. It can get very confusing, muddy, even for an advisor, right? For us, even in the industry and all of that. Now, with that, can you just double click a little bit, talk a little bit more in detail about the indices that the standard does have and where they're stacking up? Because I think that's a very, very important discovery that just came from that conference.
Yeah, and that was the distinction, particularly with the Enhanced Choice Index, Enhanced Choice Index Plus. Prior to 2022, we were S&P 500, par, and cap. And for those listening to the audience, you should know what those are, but participation rate or a cap. S&P 500, only, simple, and we still have that product for people that kind of want a beginner fixed index annuity.
Which we love.
Yeah, it's a great product.
To us, that's the foundation of any crediting strategy for an index annuity. Now, beyond that, there's additional upside that's provided.
Right. And so what we saw, we've seen the advent of these volatility or managed risk or engineered indexes that might give the potential for greater upside, because what we saw, particularly in the low interest rate environment, caps came down, par rates came down, and there's an equation between fixed interest rates and the ultimate option budgets that purchase these various indexes. So as a consequence, the industry as a whole went to these volatility-controlled indexes. We were one of the last to offer that, but people like choice. That's why we call it the Enhanced Choice Index Plus. So relative to the indexes, yes, we still have the S&P 500 pure, as I like to call it, both a par and a cap rate 10% or more, depending upon when people listen to this podcast. It's going to be 10% plus, maybe even closer to 11 by the time this goes to air. So that's a very competitive cap rate on the S&P 500. You ask kind of where the migration is. We still see because the cap rates on the S&P 500 have gone up overall as an industry, as you've probably seen in this practice, a lot of people are going to that. And so it makes some sense. An allocation into that index, we still see that happen a lot. So we have that option. But we introduced some very unique S&P 500 originated indexes.
2 or 3?
We actually introduced three.
Three,
Three
okay.
S&P 500 indexes.
The Mark, ESG, and
The daily risk.
Okay.
So
unpack those,
Yeah.
please.
So basically, in terms of the overall guidance, these are 5% volatility control, which they try to limit the degree of volatility in the underlying index element by balancing between the actual index itself, which are variations of the S&P 500, and fixed rate type of instrument. So
created by Standard & Poor's.
yeah, created by Standard & Poor's, the Dow Jones indices. So we have those. A brief summary, the Mark V index is a multi-asset index that includes a gold component. So you
And
have,
Mark stands for multi-asset risk control.
That's correct. That's correct. So we have that. The daily risk simply is reassessing risk on the S&P 500, S&P 500 daily risk control, assessing that every day and making the allocation to manage volatility with the goal of having equity exposure but protecting from some downside by having those two components at play. And then our environmental social governance index.
Of course, you got to have that.
We got to have that. Well, in what I call it is just smart indexing. Even though that term has been much maligned, environmental social governance, I'm going to call it ESG, extraordinarily strong growth.
There you
ESG. But those elements in that underlying index focus equally on environmentally friendly companies, though interestingly enough, Exxon is in there, but Exxon has a significant commitment to clean energy and even traditional carbon emitting energy to do the best they can with that. But it's also important about the G part, the governance. How well is the company run? And what we find over time, gosh, we see it every day. Well-run companies tend to do well. So we have that. We have the SPF fiasco. That company was not well run.
Right.
And so that had a problem. So when you have that well-run companies in this underlying index, and it's a variation of the S&P 500. It's got about 325 constituent members of the S&P 500. So it's just a way of choosing certain companies that we hope will perform well on behalf of our policyholders. And indeed, as you noted, it was the number one performing index as measured by the Index Resource Center's Indexalyzer from September to September, the actual strategy in our product. Number one. And so that kind of confirms, hey, this is smart indexing. It's forward-thinking indexing, so we have that. So those are the S&P 500 indexes that we have, the S&P 500 Pure, the Mark V, the Daily Risk, and then the ESG index. And then to cap it all off, we added the Bank of America Global Megatrends Index that actually brings in some global exposure. So there's a degree of global exposure. We saw in terms of our index offerings, what do we have? It's all S&P 500 based, so all US-based companies, which is great, but people like the ability to have some exposure. It's more of a forward-thinking, new economy type of index focused on industries that are into artificial intelligence and electronic payments and disruptive technology, all the things forward-thinking that we think may do well over the next few years. And so we have that index as well. It's relatively new and it's unique to us. These other indexes that I referenced, all great. You can get them elsewhere, as you know. You can get them on other platforms here in your practice. But that Bank of America, B of A, Global Megatrends, unique to the standard and unique to the ECI Plus.
Okay, so very competitive rates, clean, simple, consumer-centric products, predominantly domestic indices to choose from. However, we've now introduced a global option with the Bank of America strategy, as well as, we would be remiss if we didn't say, also a very, very competitive fixed rate option that's included in all the products. Moving on from that, I'm going to, last but not least, and I'm going to tee up some red meat for you here, okay?
Nice.
All right. In many of the situations that we have, we come across, I would say, dusty money or legacy money. So that aging client that has a pool of resources that they've just set aside for the what if emergency and or typically the medical emergency in their mind, or ultimately it's a legacy play. It's going to go to loved ones, charities, whatever they want. And in many cases, it purely is that, or it's, I'd really love to leverage my dollars as efficient as possible, which would have been a life insurance play, but I'm not insurable. In walks in the standard with their ECI Plus and the fill in the blank.
The Legacy Max Death Benefit Rider.
Bingo.
The best in the business.
All right, let's talk a little bit about that. And I can get a little bit into the weeds after you tee it up with some specific values.
Yeah, so, it's kind of like, well, wait a minute. This is kind of like, oxymoron. It's like, it's trying to design a horse by committee that ends up looking like a camel. But these two things go together. And I think for the advisor audience that you have, we need to think about what our clients view their assets as opposed to what we think they are. And so, for example, we say, well, they got life insurance. It must be for legacy and death benefit. They may have it for income. There's an income option within a lot of life insurance cash value policies. Similarly, on an annuity, we think, oh, that's for income or asset preservation. That kind of, it's for live on type of money. But at some point in time, and this is statistically proven, most people will die with their annuity either fully or partially intact. I've yet to meet that client that manages to get their last dollar out of their annuity, and then they say, God's going to call me home. It's time to go. Even if they're taking income from it, even if they triggered an income rider, there's generally something left
residual
over.
Value, of course.
And a lot of times people never even annuitize, never take money out. And that's really the signal to the advisor. Do you have clients that are not exercising the income rider that they've had? Are they not exercising penalty-free withdrawals? Are they lamenting taking their RMDs? Why did I get this check? I don't need this money. Hey, the government says you got to take it. So for anybody like that, that's a signal that their annuity has become leave-on money. And so that's the key, is to understand that you have that element of just regular clients. And then the other element, in terms of the sales example that we talked about prior to the broadcast, is those people that definitely want to enhance their legacy, but either can't qualify or find it difficult or just don't want to go through the exercise in and of itself, or quite frankly, want to have it as an added value, but still want to preserve that accumulation element of the FIA. And that's the thing. You don't have to forfeit that part of the fixed index annuity to get this significantly valuable death benefit.
Wonderful. Okay, so am I seeing this right? 6% compounding?
That's correct.
Could this be true?
It is true. In fact, it even gets better. So, one of the hazards in this in the world of death benefit riders is some illusory benefits or idle benefits, which is, are you really going to get this? Now, the big thing is unlike an income rider, and I love income riders, a death benefit's going to get paid. At some point in time, it's going to become real money. So
right.
that's number one. Now, is it substantially real money? And that's where some of the challenges come. So what we designed is a minimum, and that what you reference here, 6% compounded. And remember, Mark Twain said the greatest invention known to mankind is compound interest. 6% compounded interest for death benefit purposes all the way up to age 85. And so that is substantial. But I mentioned specifically, Scott, that's our minimum benefit. So the first caution is, well, Paul, these other carriers, they've got 7% and 8%. I even see a 10%. Well, that's simple interest. And the reality is simple interest over time, in terms of the conversion to compound interest becomes less and less. I was shocked. There's 7% simple interest rider out there, good company. It grows for 15 years. I said, well, what's the equivalent of 7% over 15 years? It's actually 5.4% compounded.
Okay.
Now if they went out and said, hey, we got a 5.4% compounded rate for 15 years, I think that's still valuable. It's not 6.
Right.
And so this is the key to understand. Now that's, again, our minimum benefit. We also have, in essence, a performance doubler factor. That's very exciting because we just talked about all the different indexes we have, the upside potential, uncapped indexing by way of the participation rates. And so now, unique to the standard, we have this dual strategy. At minimum, you're going to get 6% compounded. That in and of itself is a substantial benefit.
Coupled with interest rates we have not seen in well over a decade, by the way. So
Absolutely. So, with the performance potential, if the underlying performance of whatever index allocations you choose, if they do 5, the credit towards the death benefit is 10.
Wow.
If it does 6, it's 12. And what
locked in.
Locked in. And the beauty is basically the analogy I give, if the audience can visualize this, it's like going to your baseball game and keeping 2 scorecards. One scorecard, you score 6 runs an inning, guaranteed, it's going to happen. Or you'll actually credit double what your team scores. So if they score 5 runs in the inning, you're going to put 10 runs in that score column. These 2 score columns run side by side, inning by inning by inning. Whichever score is highest when the game is called, and in the case of a death benefit, when the client passes on, that score is what they are going to get, their beneficiaries are going to get paid as a death benefit. So that performance factor enhancement is really what distinguishes us. And it makes so much sense because it's a direct linkage to what the FIA does, which is hopefully deliver performance. So it all goes hand in hand. It's really what I call performance insurance. So with the death benefit rider, this value is real. It can really serve people that want to enhance the legacy of their fixed index annuity. They've made that determination that they have that, but it's not a full commitment. They can still do all the things with their annuity, including unqualified money. This is the other exciting part. Unqualified money, you can take your RMD, and taking money out does not eliminate the growth factor. In fact, with an RMD, we do what's called a dollar for dollar adjustment to the death benefit. That's very favorable. In essence, on the death benefit, it can grow even though you're still taking RMDs out. So you can kind of have your cake and eat it too.
So let me give you an example, and then let's wrap up a few specific elements to this. We ran an illustration. Where do advisors go to find out more about the standard annuities?
Well, they would go to your firm first, but for the standard,
thank you for that. I appreciate that.
It would be standard.com/annuities. All our rates, all our product information, and our illustration software is PIN and password free. So standard.com/annuities. That'll take you there. You want to choose not affiliated with any distributor. That'll give you access to the full menu. If you happen to be one of those advisors affiliated with a major broker dealer, we have specific drop down for your particular BD, so you can get the product versions that are approved by your upline. So keep those in mind. So you go right there, and all that information is readily had.
Okay, so we ran an illustration. Thank you. Female, age 54, 55 actually, and $1 million for establishing exactly what we talked about, leaving a legacy.
Right, and we did that. That's a real case, as you know. Somebody that this woman had kids in elementary school, high school, and she's got a chronic illness of some sort. I don't know the particulars of it. Not fatal, but will impair her ability to get insurance in general, and may limit her mortality at some point in the future. So this is the key, because the accumulation potential of this death benefit is substantial. In running it side by side, the 6% compound column with the performance doubler column, there are significant benefits that her beneficiaries will get over time.
Yeah, the numbers are staggering. So with that $1 million deposit in 15 years, so in this case, age 69, the guaranteed death benefit value grew to $2,396,558. That in of itself is an incredible number. However, it's hard to believe what I'm seeing here, but the performance enhancement value was $13,304,383. Those are real dollars. How would that be paid out? What are the options that the beneficiaries would have at that point?
Again, as an example of the consumer-friendly focus of the standard, it is available as a lump sum. There's a lot of times with benefits coming out of annuities or insurance products in general, they're limited in some way. Well, can I get a 10-pay? You can get a 10-pay. That's an option. But
you can with the standard, because I would think at these dollar amounts, right, even just from a purely taxation standpoint, I would not want that in a lump sum. I would want to try and leverage.
Right, and it should be said, should be disclosed. These are annuity benefits coming out of an annuity, just like withdrawals, just like income rider payments, just like RMDs, and just like death benefits.
It's not life insurance.
It's not life insurance. It's a death benefit rider on an annuity, so those benefits are taxable. But still, even if you net out the taxes, and then really that's another idea about it, is that if you have that intention to leave the annuity and have this growth factor, in essence, you can net out the taxes and actually leave the original corpus to your beneficiaries. That's one great advantage.
So this must be expensive. What does this cost?
So there is a fee associated with that. It's 150 basis points. But again,
that's incredibly fair.
I think it's fair. And what's important to people understand,
most riders today are going to be 105, 125 basis points, something along those lines.
Yeah,
this is incredibly competitive at a 1.5%.
Well, you get what you pay for, because it is the best benefit in the business. And what's important to remember, Scott, is that fee does not affect the death benefit. It comes out of the real money bucket. It comes out of the accumulation bucket. So, the fees can gather over time, but it does not affect the death benefit. So that death benefit, 100% of the original deposit is cruising along at 6% or getting that performance double credit, and then whichever benefit is higher gets paid.
Excellent. Is there any other details that we may be missing before we close?
There's one that I want to share with the audience, and that is for spouses. This is the ultimate spousal annuity. And that meaning, any couple, God bless, one person's going to die first. So whatever you have. We're all familiar with spousal continuation. Mm-hmm. And so you think, okay, what can I do? So we do at the standard something that I think only one other company does, which is one spouse dies, the other spouse is the beneficiary. That's how you have spousal continuation. Now, the spouse can cash out, take the death benefit. Okay, that's great. Or the spouse can continue the death benefit and continue the rider, or they can actually gross up that death benefit into the annuity, can't continue the rider, but now you've got what has become a death benefit into a living benefit.
Wow.
And now built into the annuity is that substantial, over time, death benefit that can be rolled into the existing annuity and not incur any taxes at that point in time. Of course, when money comes out, taxes will be due at that point. So those three options: cash out, take the death benefit, substantial; continue the value under spousal continuation, and continue the death benefit rider; or roll up the death benefit difference between the accumulation value and the death benefit, and now that becomes your principal or your value
new
now
base.
On which the new base. Yes, thank you for that. New base on which the growth potential can occur.
See, those are the benefits that we like to be a part of and to distribute. The actual solutions that act and provide solutions in the best interest of the client. What a concept.
It is amazing, and that's kind of brings us back full circle to the beginning. Why are things so good? Rates are high, terms are great, the products are shorter, better, and they are consumer-centric, certainly at the standard.
Thank you for your time. God bless annuities.
Yes.
Till next time.
Indeed.
Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment, or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.